So let's start. What's this club about? Finding great businesses. And I don't know if you've read the book, but it's worth reading. Go through the book, and it's trying to find these businesses when you realize what the big winners are and where they are. And I keep saying this, the market's too many stocks to actually pay attention to all of them. So concentrate your research on the area that's going to find or produce the best results. And these tend to be, sub 100 million market caps with growing revenue, good value. And so that's what we're looking for, essentially. Maybe even a super stock, because the traits we're looking for pretty much, these super stocks would fit them. That's 1,000% more 10 bagger pretty much, and this is basically set up the MicroCap League to find these kind of businesses, and they're scored and color coded to try and find these businesses, try and wheel them out. Ask yourself these 3 questions before investing. It's good to have some focus. Like I said, investing is very complex. And it's taking years to sort of find the area of the market that's going to produce the best winners. But it comes down to this. Ask yourself these 3 questions to cover off the 3 most important aspects of investing. This is what I do. I mean, you can follow this, of course, but you don't have to. Everyone has to find their own way. But what, when, how? And I sort of highlight this in the book. And what is fundamental analysis, looking at the financials and so that. Does the company possess growth and value? Those are 2 most important metrics for growth stocks. Growth is the most important, value is second most important, and they are scored accordingly to the highest scoring metrics on the website. Okay, and also, is it a performer or recovery play? Like I said, there's a recovery play. In fact, I don't know if you saw Zoo today. Look at that breaking out there. This was a recovery play. I just basically got in here on the trading update. It was very bullish, and they broke up. This, when you see some companies that fly like this, sometimes, not always, the hype can come back. This kind of hype here that's driven the stock up. And I thought when it rose to this level, I thought it's overvalued. I sort of missed it. I interviewed the CEO down here, but that can come back in when they get that growth back. I mean, maybe not all the way back up there, but like I said, they're going to release their results, of course, final results, which are not good because it's looking backwards, those results. So it's the outlook statement that's important, but it may take a knock on those results because people tend to look at the results, see the growth is down for last year, but ignore the trading statement. And that's another thing. Look for trading statements that give you a glimpse into the future pretty much before the financial results come out. And I talk about that in the book. It's pretty much, it's the first sign a company's, publicly revealed it's turning itself around a bit when they release a trading statement. And a trading statement, of course, is a preview of their interim results, which is H1, the first half of the year, or the full year. And sometimes they put a bit of a shine on it because they don't reveal all. They reveal the best bits tend to, but they can tell you if a company's starting to recover. So recovery versus performer. Performers, if it's a performer, it should possess growth and value. It's already there. It could have been a previous recovery play, but now it's performing. An example: so Time Finance, pretty much everything. Top line growth of 15%. It would be in the green if it had 20%. But nevertheless, every other metric pretty much is green. Almost top scores in both. Also, Synectics again, almost all green on the growth and the value. So they are performers. If it's a recovery, it should possess value. It can't be overvalued, pretty much, and it's gone through a period where it's had a bad patch and still be overvalued. It should be good value, even brilliant value, if it's going to recover. But of course, if it's not going to recover, it becomes even more compelling value because it's not doing well. And if it's a recovery play, how confident are you the growth will return? Because if it doesn't, it's not going to recover. Full stop. So hope that makes sense. Performer has both. Recovery play has good value, but hopefully growth will return. And then if it does return, it'll be excellent value because generally after companies issued a couple of profit warnings, they'll be oversold massively. And if they're regaining their previous growth, it should kick back up. Example of this, by the way, is ADF. And this is a typical example, facilities by ADF, where I think people are looking in the rearview mirror and investing here. Financial results this week. And, they supply all the sort of trailers to the TV and film industry in the UK. Their clients are like everyone from BBC to Netflix to Amazon. I think they're one of the biggest suppliers in the UK. The trailer count to over 700 by the end of 2023, that was. Now, It doesn't look that compelling here, but that's after. This is based on these results, which were bad for them because the writer strike, of course, slowed down all productions, and that ended in November. So, of course, it affected last year. That's last year's results. Now, if you look what they said in their statement about, H1 this year, it's going to be significantly ahead of H1 last year. And you scroll down, the value's fine because the value is based on those last results. So this is what you need to look at. Stocks are also about what's going to happen, not what happens. So sometimes you can get a bit of an opportunity because they'll release their final results and they won't be very good and the stock will go down. But they've already said that, business is improving, operations improving, growth is happening. And that's what's happened here. And yet it's starting to rally. And in fact, what's the momentum here? Because, it has gone up. Yeah. Do you know what? I'm looking at that. This has gone up because that was just then. By the way, this data updates every evening, okay? So the share price changes. If they've issued any shares, that changes. And of course, that affects the value and everything. The share price goes up and down. But that was literally today below the 200-day moving average. So there was no points there. Now it's got an extra 7 points because the momentum is starting to kick in, which is quite good. Now, if you look at this, if you look at the going forward, so if you look at my forecasts, you can see for 2024, they're expecting 10% growth, even with that bad year. But for 2024, they're expected to do 35%, up to 47 million. And look at the improvement in the EBITDA, 69% and 15%, or even for the profit, of post-tax profit, 5 million, 50% gain. And so look at that. And the valuation here is very good going forward. If they hit the forecasts, there's always an if. I said, forecasts are always about looking into the future. But can safely say that they were hit by something outside their control. It wasn't company specific. That's now been remedied. And so this could be a very good recovery play. In fact, let's look at the charts. It's literally just gone above the 200-day moving average. It should have, it moved up there, a bit of volume, came back down. But that red line is 200-day moving average. That's the bull bear line, really. I often use a 50 as well. 50 is a very early indicator that something may be happening, but it can fail. So that's that. And when technical analysis, of course, the chart is the share price above the 200-day moving average. It's not 100% certain it'll go into uptrend if that happens, but it raises your odds that it is going into an uptrend. Examples. I mean, if you look at some of the examples, my holdings here, Trufin, for example, it's above that. It's above 50. Broke the 50 here. But you can see it's broken 50 before, not really done anything. So it broke 200-day here, pretty much back in November. As Billington, I didn't get in early. I didn't know about it, actually. I just read the trading update. And it rose up, broke 50-day, then gapped up. Oh, I think that's where I got in here on the gap on the trading update. Was it recently, or was it this one? I don't know. But you can see it's above this 200-day moving average. Let's look at another one. Synectics, again, above these moving averages. In fact, way off 200-day. In fact, PMI is just than that. Premier Miton, which is, I mean, if you believe that the stock market is recovering, then this could be a good play because they're an asset manager. Essentially, the more inflow that happens, the more people start investing, the more deals they do. And so I think that's why that's rallying, but it's rallied quite strongly of late. You also have the CEO buying some stock there. That's Premier Miton. It's almost like having a little fund, and they tend to focus on smaller caps, MicroCaps. So if you think, if you want a safe play on the MicroCap space, they've got plenty of cash. They did pay about a 10% dividend. But a classic sort of uptrend here is Time Finance. Look at that. You can see safely there, a couple of times it sort of fake break that. Then you had this 200-day moving average crossing. This is called the golden cross, by the way, when the 50-day moving average crosses up over the 200-day. And if you are new to charts, by the way, and you just go to the website here, where is it? And technical analysis. There's a section here where you can how to set up a chart, looking at it. But charts are like anything. Just learn about them. You can see here it's gone up nicely, a nice gradient upwards. Seeing a bit of resistance here at 42 pence. And Journeo is another one, isn't it? Journeo. Look at that. I put lines next. That's a range. I talk about that. Talk about downtrends and ranges and uptrends. So if there's a sort of downtrend, if you go back here, So it's a messy downtrend. It broke up then above that sort of range into another range, and then it broke up high again. You can see broke the 200-day moving average, and up it went. And again, it probably needs a bit of a range again. You tend to find ranges happen after an extended move. So if it shoots up with this, it needs consolidation because buyers and sellers are arguing about it. And then if they come up with good news and it's undervalued, it'll break up again and go and start another uptrend, hopefully, or a downtrend. So it will also happen at the bottom when a share price comes down, gets oversold, they release a couple of decent trading updates, maybe it'll hang around there for a while and then go back up. So downtrends, ranges, uptrends. That's three things you look out for. All right. Again, at least it's got to be above 50-day moving average. At least that's an early indicator. But a couple of times, you can see share price break that 50-day and it'll come back down. But you can put alerts on these charts. By the way, I've also discussed that. Whenever a company breaks a 50-day moving average, you can put alerts on it. So you'll be sent an email, or if you've got the app, it'll come to your phone or on your watch. Yeah, but I wouldn't set too many. Just an example, actually, Zoo that's broken 50-day moving average, but it's not broken the 200-day. You can see here, broke 200-day here at 165 on the way down. It broke the 50-day at 190, and it came down. Here's a fake break. So, for example, it's come down here, broken the 50-day moving average. Now, look at that. These are sort of previous highs, which it didn't really get above. There's a gap here. And so, all these moving averages are basically a smoothing out of the share price action. That's all they do. They're the average price of the last 50 days. So it's the share price that leads. These are lagging indicators, but they're smoothed out. Now, you can see now, slowly this 200-day moving average is coming round. It's been going down at this, coming round. So it broke up over the 50-day moving average. You can say pretty much it's gone almost above previous highs. But now the 200 days there, so it's still not quite there. But it's a good start. It's a very good start. Okay. And the most important thing of all, apart from text and in my book, I've been thinking about setting up a sort of a portfolio management tool on the website. I don't know if that would help, but I say focus on risk. And it's in a bull market, people only focus on reward, and when the bear market comes in, you're in trouble sometimes. But if you focus on risk first, not reward, you tend to be a bit more focused on what you're doing. You think about it really, because there's no reward at the start, just risk. Think, how much can I lose on this trade? Okay. Start small, instead of stop loss 20% below buy price. I've done that now. I did say this in the book. I messed around with stop losses for a long time, but I realize you're managing risk essentially. And that's what investing is all about. It's about risk. You are risking your capital. You should manage it. If you don't know how much you're going to lose, that is not management. Okay? Because if it keeps going down and down, just holding there and sitting, wait for the bounce, you're not managing it at all. So, and I tend to find in microcaps, if you are, if everything else is aligned, you can get it wrong sometimes, growth and value, and you put a 20% stop loss, that should be okay. It shouldn't really kick in. But at least you have a limit on how much you're going to lose. And why do you do this? Most investors lose money because they focus on reward too much. That means they go too big on their initial investment, and the losses start getting bigger. And some people even average down. In a bull market, it's not so bad. In a bear market, all it does is leverage your portfolio towards your losers rather than your winners. You keep chucking, good money after bad, and it doesn't help. It doesn't work out because there's no guarantee. There's no guarantee a stock price will turn around. You may think it is in your head, but you want it to. You hope it will because you've got lots of money in there. There's no guarantee of that. So it makes sense to limit the downside. Don't limit the upside. Because companies can go on and do multiples and multiples, especially microcaps. So I've seen people, do. That's another thing. Private investors get wrong. When I've done that, taking a profit too early and holding on to their losses. Now you add those two together, and you've got a portfolio guaranteed to be leveraged towards your losers rather than your winners. So take the loss early, don't take the win early. Okay, don't back your losers, back your winners. After they start winning, like I say, there's lots of companies I've invested in, and I thought that's going to be a huge winner. And it turns out another company I own has done better. You can never really tell. And I do liken it in the book to horse race. People say investing's not gambling. Yes, it is. But you've got better odds, that's all. It's about probability. So essentially, 20 horses in the field, and that's like, investing. That's what I'm doing at the moment. I don't know which one of these will play out massively. I hopefully, if you back 20 horses, okay, and then halfway through the race, you can see some of them not winning or anywhere near winning. Stop loss kicks in, and say out of those 10 leading horses, out of 20 horses, maybe one will come in, 10 to 1, 10 back. Maybe the second one will do 3 times your money. Third one, maybe 2 times. A few others will make nice gains, but that's what you need. So you need to find that winner. And when you know one's winning, start sort of averaging up, because you're talking about in microcaps, it could do multiples. So there's plenty of time to average up on that winner. And that's when you really sort of leverage towards your winners. Anyway, go to the website and read that. There's a bit more detail about this.